Why do XIRR, CAGR, and rolling returns vary for the same portfolio? What is CAGR for an investor? Is XIRR more relevant for SIP investors? What do rolling returns mean? Which metrics should an investor consider? Hello and welcome to Investors Hangout, a space where we step back from the noise to focus on what really matters for long-term investors. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, as we approach the end of the financial year, it's time to review our portfolios, and many of us are doing that. But when we open our statements, look at the returns, we almost instantly run into a familiar confusion. CAGR, XIRR, rolling returns. Different numbers, different stories, and sometimes very different conclusions. So today, we'll help you decode which metric really matters when reviewing your portfolio. And to help us decode that, we have with us our CEO, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
So, when reviewing our portfolio, we see different metrics, XIRR, CAGR, rolling returns. Why do these numbers look so different?
CAGR, XIRR, and rolling return, they measure different things. They are meant for different purposes. The end goal is completely different. Particularly in the context of a mutual fund, one tells you how this fund did. And you can compare it with benchmark, that this fund went up from whatever X to Y, and this translates into something like 12% return. And how did the benchmark did? So you are looking at a one-time return and a holding period return for a given time period. So 3 year, 5 year, 10 year. So that is CAGR. The other one, which is XIRR, tells you how you did based on the periodic investment that you made in a fund. So investing may not be, particularly in an open-end mutual fund, investing will be a periodic activity. You invested in a fund, then you started your SIP, then you took out some money. And as a result of all these actions, and there is a timeliness, the timing gets reflected in this. So what is your return? What is the return that you have earned by investing in this fund, factoring in the timing as well as the quantum of money? Third is, rolling return. This is a return which is more of a probability, because if you look at CAGR or if you look at XIRR, these are things which are dependent on what you experienced. You invested on a day, sold it on a day, that is CAGR. You did some periodic investment and you took the money out, or this is the worth of your investment, what is your XIRR. But rolling return is something about a fund that if you invest for a 1 year period, what is the likelihood of getting that return? What is the probability? And it is an average of a 1 year return achieved by that investment over a long period of time. And so that is, rolling return is a probability of return that you are likely to get, or it has delivered. Where is the concentration of return in that particular fund? Range of fund.
Okay.
The range of return.
Now let's break them down one by one. First, CAGR. What does it mean for an investor?
CAGR is a very simple compounded annual growth rate, which is a simple average growth rate per year. You invested 100 rupee, it went up by 10%. Next year, your capital becomes 11. Then you earned another 10%, add 11, so it becomes 121. Then add another 10%. So if you earn 10%, based on the investment and based on the terminal value, what is the worth of investment, and that being annualized, that is CAGR. So you should compare it more like a fixed deposit, more like a bond, a cumulative bond, that if you had the choice of investing in this investment as compared to the other one, or point-to-point return for a lump sum. CAGR is very useful for an investor who invested once, then you stay invested for a certain time period, and then you took the money out. You would like to see what my return is. That is what is CAGR.
So most people these days, they invest through SIPs. Does that mean XIRR matters more?
Oh, very much it matters more. One is that the case for SIP is a completely different one, which is a psychological. That it matches with your income stream, and then you are doing that periodically, and it helps you navigate. But more importantly, you are investing when the market is low. We are investing when the market is high. So timing is also reflected, though you are not doing it. The whole thing is not about timing, but that gets factored into the return because you are not buying it at a constant price. And so you invest low, you buy low, you sell low. So a more volatile investment, which does very well over a period of time as compared to a very steady investment the XIRR of the more volatile investment is likely to be more because the likelihood of buying or investing at points which is the timing gets reflected. So every SIP that you make, when you make it, and it's to the terminal value of all that accumulation. Also, it will factor in different amount of money, the scale of money getting invested. If you started your SIP with 500 rupees 20 years ago, and today you are doing 50,000 rupees every month, the amount of money which is at work for what time period, that gets factored in. So XIRR is the most precise, accurate return, which should be your reference, which takes into account the quality of investment, the timing of that investment, the time period of that investment, and eventual performance of that investment.
So XIRR is the investor's return.
Is your return.
Your return, right. So, but many investors, they feel disappointed looking at XIRR because it looks very low when compared to CAGR. So, can you explain that? Why does that happen?
It may not always be true. If you are doing your investment for 20 years, your XIRR will look very handsome all the time because most of your investments were done which was at a much lower level and the returns get enhanced. The real problem, this situation arises for those investors who have started in recent times. You started investing 3 years ago and the market has been going up, and a 10% decline, it reduces your XIRR substantially. So time will take care of it. XIRR for a relatively new investor might be disappointing when the market crumbles in recent past, and so XIRR drops. But likewise, another 5% jump and the XIRR will look nice again. XIRR becomes more stable as your investment time period gets longer.
Okay. Now comes the rolling returns. What does that mean?
Rolling return, the way it is calculated, it basically shows consistency. If you are looking at 3-year, 5-year, 1-year rolling return, how the fund has done if you held it for 1 year, for a long period of time and doing an average of that. So you have a better understanding. It is not dependent on 2 specific dates because that could be very misleading. There is a possibility that 1 year or 5-year return for a investment, or the day when you are looking at it, 5-year CAGR or annualized return when you are looking at a fund for evaluating whether you should invest or not, that might be completely misplaced because 5 years ago it turned out to be an accidentally low date, and today it happens to be an accidentally or a fairly elevated level, and the returns could look very handsome, and that will be misleading. So what is the likelihood? Looking at the consistency of return, if you are looking at the likelihood of getting that return or how this fund has done over a certain time period for a certain specific holding period, that is where rolling return comes in.
Okay, so it's basically average return of a particular period,
fund,
3 year, 5 year, 1 year, whatever, average return that the fund has given. Okay, all right. Now, final takeaway. Which one should I look at while I'm reviewing my portfolio? So if I need to take any action, what is the metric that will tell me that here is what you need to do?
They all have 3 different purposes. When you are evaluating a fund, that if it has done better than its benchmark, better than its peer, I will look at CAGR over various time periods. If I have to look at my portfolio return, I will look at XIRR because my periodic investment, I did not have money when the market was low. My returns will not be very, very high. So it will factor in all my actions as well. And XIRR is useful for that. All these returns have basically 2 purposes. One is when you are deciding which fund to invest in. You want to look at returns, how it has been achieved. So look at CAGR and rolling return in conjunction. Because when you look at CAGR as of today, because CAGR is trailing, you are looking at the returns as on today. So it is a function of how the market was or how the fund did over this 5-year period, 3-year period or 1-year period. You get a sense of that. You can very easily compare it with benchmark. Then when you look at rolling return, and if you see a wide variance, then you realize that how should you attach greater weight to the CAGR or rolling return, because rolling return is more robust. It will give you a sense of what is the likelihood, what is the kind of range, is the current number, because there will also be a possibility that CAGR will look very, very low, very disappointing at a certain point, but the rolling return might be higher, which means at the lower ebb of the market, it will be more useful. So getting some kind of reality check or validating that how reliable or how bankable. Don't get there is a likelihood of getting misguided just by looking at CAGR at a certain time period. Rolling returns brings you the guardrails, gets you a more realistic sense of what to expect.
All right. So returns are important, but context is what.
Context is important, and how are you using it? And the simplest thing which people look at, 10 रुपया लगाया था 20 रुपया हो गया है, they don't factor the time period.
Right.
10 rupee becoming 20 in 5 years time is not the same as becoming 20 in 3 years time or in 1 year.
All right. Well, thank you for explaining it so clearly. And to our viewers, do remember, if you're reviewing your portfolio, the right metric leads to right decisions. So be mindful of that. That's all we have for you in this episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thank you for watching.